and welcome. My name is Pravin Krishna, along with Poonam Gupta and Karthik Muralidharan. I'm one of the co-editors of the India Policy Forum, and it's my pleasure this evening to welcome you all to the IPF 2023 lecture. Our speaker this evening is Professor Hélène Rey, the Lord Bagri Professor of Economics at London Business School. Professor Rey is an enormously distinguished scholar who's made seminal contributions in a number of different areas in international economics, particularly on the determinants and consequences of external trade and financial imbalances, the analysis of the global financial cycle, the theory and empirics of financial crises, and the organization of the international monetary system. Professor Rey is an elected fellow of the British Academy, of the Econometric Society, of the European Economic Association, and of the American Academy of Arts and Sciences. She served in a number of distinguished positions, including as president of the European Economic Association and on the editorial boards of the Review of Economic Studies and the American Economic Journal. So we're really thrilled to have Professor Rey as IPF Speaker for the year. Given the pressure on the global economy today from the many complex and interconnected economic and geopolitical factors, Professor Rey's lecture on monetary and macroprudential policies under the global financial cycle is very, very timely indeed. Chairing this session is Mr. Suman Bery, who is Vice Chairman of NITI Aayog, the apex policy think tank of the Government of India. Prior to this, he served in a number of distinguished positions as Global Chief Economist of Royal Dutch Shell between 2012-2016, and closer to home here as Director General of the NCAER between the years 2001-2011, having returned to India in 2001 after a long distinguished career at the World Bank in Washington, D.C. So welcome everyone again, and let me turn this over to you, Suman.
Thank you, Pravin, and I'm very pleased to be present in person. Last year, sort of diplomatic duties meant that I had to miss the IPF, which was meeting physically after, after a gap. And boy, is it back with a bang. I mean, Poonam has certainly been working very hard, both on, on fundraising and papers and things like that. It's a particular pleasure, and I mean that very from the bottom of my heart, to chair a lecture by Dr. Rey, in part to reciprocate her welcome at the London Business School. I was in London in February, and she chaired an interactive session between me and students of the London Business School, but our personal connection goes back earlier to that. So I do also want to say it's an inspired choice by Poonam and to invite Hélène to give the IPF lecture, and appropriate in India's G20 year. Because, as you will see, she explores, Dr. Rey explores fundamental asymmetries in the way that global finance today impacts on advanced economies as against emerging markets, and these are issues of great concern for the G20. I should add that these are not new themes for the IPF. We've talked about the last 20 years, and I think the first volume of the IPF was published in the wake of the Asian financial crisis, and not long after the Taramore Committee, on which Surjit Bhalla was a member, published its report on the liberalization of the capital account. But as Dr. Rey's presentation will reveal, today's world is dramatically different, both because of what's happened to global finance and because of the rise of China, two big shocks, if you like, or the changes in the world, and we have to, learn how to deal with them. And indeed, one could say that part of this process of evolution has been the creation of the G20 Leaders Summit process in 2008, 2009. Monte Carlo is in the room. He was Sherpa at that time. And the leaders process was convened in response to a financial shock. So if you like, finance has very much shaped the world that we now live in. It has shaped it in ways that are perhaps poorly understood. But what I know as the person who's mandated to think through what it means for India to be to aim to be a developed society by 2047 is that this will involve engagement with the international financial system, but exactly what the terms and tenor of that engagement would be, I think, are open issues, and I'm certain that Hélène's talk today will uncover a rich vein of follow-up research for the IPF and Indian academics to take forward. I think by either by happenstance or design, we have two very distinguished commentators on global finance in Barry Eichengreen, Martin Wolf, and when we get into the discussion, I think getting their insights as well into how to reshape global finance and money in a way that helps the global south, helps India, would be the direction in which I'd like to take the discussion. Without further ado, let me ask Hélène to embark on her lecture.
So thank you very much, Pravin and Suman. So first of all, I'm extraordinarily happy to be here in Delhi. I'm even happier to be here and seeing all my old friends around. And it's a great honor to deliver that lecture. I was also very heartened when you said that, there are all these connections between the European Union and India, because I really believe so. And it's actually a comment I made this morning to the paper of Punan and Bery, because the macrofinance linkages that they were mentioning regarding the Indian states and the doom loop between the banks and the states and the ownership of debt and the fiscal accounts somehow sound extremely familiar. So I'm just hoping that India and the European Union and the Euro area will have even deeper ties. I think it's going to be very fruitful for both sides. Now, this said, I'm not going to talk exactly about that today. I'm going to discuss a range of issues that I've been working on, which have to do with global financial cycle and the implication and the role of monetary policy and macroprudential policies. So I'm going to be building on the work that I've done with a number of co-authors for this lecture. So I'm the last speaker of the day, so I thought at least I should show nice photos and nice pictures, colorful things to keep you awake. So I'm going to show you my a little bit of a broad vision of the world right now. What you can see on this graph is the trade network of the world economy at two different points in time, in 2000 and in 2019. And what you can see is that if in 2000 we have some big nodes there, so the nodes reflect the size of the exports and imports of the countries, and the arrows are the exports. Okay, so you can see that we have the US, which is a big node in 2000. We have EMU is the Euro area. We have a number of other big nodes. We have Japan. India is not very big yet. And we have a number of other countries. Fast forward from 2000 to 2019, and the world looks a little bit different. We go through a world which looks tripolar. Well, there are these three big nodes now in the world economy. You have still Europe, the US, and you have China, which has emerged as a large trading power. And India has grown a bit also by this measure, but it would have grown a lot more in the more recent period. But still, we have this multipolar but really tripolar world that has emerged. So that's what the world looks like if we focus on trade linkages, international trade. Now I'm going to show you what the world looks like in terms of international finance. So that's the finance network. Again, 2000 and 2019. And there, you see that we have, again, a big node, which is the United States. We have a big euro area node as well. And we have some other nodes which are relatively big, the UK, Japan, Switzerland. But essentially, everyone else is relatively small. And if we fast forward now again to 2019, actually, we still have the US very much in the center as the big node. We still have Europe, which is relatively big. And then we have, again, other satellites country, but we certainly don't find China there. So the international finance world is very different from the international trade world. And here, the international finance leakages are measured as portfolio flows, equity and bonds, across countries. And again, the size of a node is proportional to exports and imports of securities. And the arrows are investment into securities, portfolio securities, in other countries. So that's what this graph looks like. So asymmetry. The trade world looks very different from the financial world. And the financial world is still very dominated by the United States and the Federal Reserve, which is still the main central bank in the world economy. So what implication does that have, and what do we know in addition to this basic structure of a network in terms of international finance and this globalization that Suman was talking about? Because what happened massively since the 1990s, as we know, is that there has been a lot more financial integration among emerging markets, among advanced economies, and much larger stocks of cross-border assets and liabilities compared to what we had in the 1970s and the 1980s even. So we have had a very large increase in financial integration with that specific network structure, which doesn't reflect the trade structure, okay? So I think some of the stylized facts that we've learned from research is that there is a global financial cycle in the world economy, which has appeared mostly after financial integration have increased in the end of the 80s, beginning of the 90s, where what we see is strong co-movement of a number of financial aggregates on a global scale. So what do I mean by financial aggregates? I mean risky asset prices, so I'm going to mean valuations of assets. I mean also capital inflows and capital outflows, credit and leverage, and risk appetite, okay, on international financial markets. And the first fact that I want to show you is that there is, actually, if you take a big, gigantic panel of risky asset prices, by which I mean individual stock prices, risky corporate bonds prices, and you estimate a dynamic factor model, so that's a model in which you try to see if there is common variation across all these prices over time, what the data shows is that there is one global factor. Okay, there is one global factor, and it explains about a quarter of the variance of that very large panel. So that's fact one. There is a global factor in risky asset prices, accounting for about 25% of the variance of movement in valuation. If we look at capital flows, interestingly, you do the same thing. You take inflows and outflows. You take a gigantic panel across all countries, and what you find is that there are two global factors in gross capital flows. And together, they explain about 35% of the variance. So in both cases, non-negligible amounts. Now, the question is, what do these factors look like? So there is these common cycles. What does it look like? Well, that's what I'm going to show you now, because I have all these graphs for you. Here we go. So you see on the left-hand side here, I have two lines. The dark line is the global factor in asset prices. And the orange line is the global factor, the first of the two global factors in capital flows. And what is quite striking from the point, this is between 1990 and 2020 here, the kind of striking thing, if you look at these two lines, is that they are very highly correlated. So this is one of these cases in economics where we have the volume, the capital flows, highly positively correlated with the price. It's kind of, not necessarily what you usually see in our diagrams, but here this is about, financial markets. And so it basically says that valuations, so risky prices, tend to go up at the same time as transactions, so capital inflows or capital outflows. They go up together. They co-move quite a bit. The shaded areas are the US recessions, by the way. So that's the first observation. The second observation, which is on the right, is that if we disaggregate the capital flows, the first capital flow factor, into the outflows and the inflows, well, it doesn't really matter. They are the dashed lines. You can probably barely see them. They kind of co-move together. So it's really like we have financial activity that goes up and down together, in and out. It's like there's a lot of intermediation in the world, and intermediation goes up when valuations goes up, and it goes together. Okay, so that's what this first global factor in capital flows and this global factor in asset prices look like. So that's a characterization of a global financial cycle. Okay, so that's, but there are some interesting properties to this global financial cycle. Because now, if we look at the correlation, this is just a correlation, between this factor in asset price and the first factor in capital flows, and we look at indices of risk aversions and volatilities. Typically, we use the VIX a lot in international finance, but we could use other traded indices. The VIX is reflecting the expected volatility of the S&P 500 plus some risk aversion factor. We could use the V-stocks, which would be a European equivalent. We could use the Japanese equivalent. They are all correlated. Well, the factor in asset price or the factor in capital flows co-move negatively with this. So when there is more uncertainty, more volatility, and more risk aversion, these factors go down, okay, at the same time. That's a negative co-movement that you can see here in the first panel. If we are a little bit more sophisticated and we find some risk aversion indices which are extracted from the finance literature, for example, several papers by Gerd Beckert and co-authors, or some of my own work, what we see is that risk aversion is negatively correlated with the global financial cycle. So there is this kind of global risk aversion, which some people say risk on, risk off type of ideas, which co-moves negatively with the global financial cycle. So that's a second kind of empirical observation. Now, I said there are two global factors in capital flows. So what does the second one look like? So that's the second one. It looks very different. And that one is highly correlated with commodity price indices, with, in particular, oil price, with international trade as well. So that's an interesting thing because it's a completely different pattern. Doesn't seem to be related to this financial market activity that we just found out, but it's related to the commodity cycles and to the international trade patterns. So that's the second factor in global capital flows. Now, I have showing you here, maybe it's a bit small for people in the back, I'm sorry. I'm just going to give you a brief summary of this, a bunch of correlations. So these are just correlations, okay? These are just stylized facts. So the first factor in asset prices, as I told you, it correlates negatively strongly with any measure of risk aversion that you're going to find. And this is the first column with the kind of yellowish bars. That means there are high negative correlations with risk aversion. The first factor in capital flows correlates a lot with that factor. So that's a global financial cycle. More interestingly, the second factor in capital flow, I'm showing you the correlation here with the commodity price, with the world trade, and with, interestingly also, there is the dollar exchange rate. And here the correlation are very strong. Okay? And so that's a different pattern of correlation, which are also extremely strong for this second factor in capital flows. And then I have a bunch of other things on private liquidity, etc. This is not as important. So we have a very distinguished set of stylized facts here. The question, the additional question then, for the moment, I've just shown you facts, essentially, about what financial globalization looks like. And we see that we have kind of important, it could be common shocks, it could be different mechanism that links to these correlations across countries, across continents, of important international financial variables, and the correlation of flows, both with financial assets trade on the one hand, and with commodities and trade on the other hand. Okay? So that's the first set of facts. Now, the next research question is obviously, can we identify some of the drivers of these cycles? Whether we think about the global financial cycle, whether we think about the commodity and trade cycle. So that's what I'm going to try to do now. And for that, I'm going to go to the first usual suspect, which turns out to be an important one here. Given, and I've also written a lot about the role of the US Federal Reserve and the US dollar in the international monetary system. There are lots of measures of the importance of the dollar in international banking, as a currency of issuance for bonds internationally, in world reserves, etc. So there are lots of reasons to think that when we think about international financial flows and international trade in financial assets, the dollar is a kind of special currency based on the position of the dollar at the center of international monetary system. So there is a strong presumption that maybe actually the Federal Reserve and the monetary policy of the Federal Reserve might have some effect on the global financial cycle. So here this is precisely the hypothesis that we test, and here we are talking about causality. So I'm going to be able to show an effect of the US monetary policy on a number of variables here. So these are impulse response functions. So on the horizontal axis, you have months, and you have a bunch of variables that come from a VAR. So it's time series studies with a number of important international financial variables here. And the way now we have an interesting way of identifying causality in this type of studies, which is really by finding an instrument for the US monetary policy. And so we can really talk about causal effect. And the instrument is based on high-frequency identification of US monetary policy shocks. So this is, if you want some details, this is going to be in several papers. But so we do find some causal effect. And the interesting thing is that the US monetary policy, yes, has an effect on a number of variables. In fact, it does have an effect on world trade, on the commodity price index. But what it's very strong, it has a very strong effect, is on world financial conditions. So this is the green boxes that I have shown you here. It has a strong effect on world financial conditions, on the global factor in asset prices, on the first global factor in capital flows, and on any measure of risk aversion. So here we have the VIX index, which is at the bottom corner of the right. So all that is strongly affected by the Federal Reserve monetary policy. So in other words, global risk aversion, the global financial cycle is driven, at least partly, by the Fed. Okay, that's the strong results that we have here from the causal point of view. Now, if we zoom in a little bit on what happens to capital flow responses. So we know the big picture of the global financial cycle, but what about the conditional response of capital flows to a monetary policy tightening by the Fed? And here what is interesting is that we do see an asymmetric response, and this was mentioned by Suman, between advanced economies and emerging markets. If we look at advanced economies, when the Fed tightens, we have a decline in inflows and a decline in outflows. So it's like we have financial transactions going down on both sides, right? So it's like financial intermediation internationally going down. But if we look at emerging markets, we have an asymmetric reaction where you have the inflows going down, but the outflows going up. So on net, that means net outflows for emerging markets. And this is not the same for advanced economies. So clearly an asymmetry here in the transmission channel of the US monetary policy. So the spillovers potentially quite different for advanced economies and emerging markets. Okay, so now that was for the Federal Reserve, and there are lots more results for the Federal Reserve, but I don't have time, unfortunately, to show them all here. If you are interested, there are lots of papers now on these issues, not only by me, but by many people. Now, another interesting issue is what about the other large central banks? And there, so I've started to do some work on the People's Bank of China. And what is very interesting is that, or maybe it's kind of intuitive, but it's interesting to see it in the data, is that the spillovers of the People's Bank of China monetary policy are entirely different. There are spillovers, but not on world financial conditions. So not on the global financial cycle. So here you see in green, these are all the responses of the global financial cycle variables, and they turn out to be not significant. You see the red line, that's 0, and it's always in the confidence bands, so that for the global financial cycle variable. So that means essentially that's not significant. So there is no causal effect of the People's Bank of China on the global financial cycle variables. On the other hand, if we look at the other variables, which are world trade, world industrial production, the commodity price index, which are here, the green boxes again, you do see very significant and strong responses of these variables to a tightening of the People's Bank of China. So that means there are spillovers, they are strong, but they are completely different, again, very asymmetric between the Fed and the People's Bank of China. And the People's Bank of China has to do with the commodities and trade cycle, but it doesn't have much to do with the global financial condition. So that's what we find. We do a specific zoom on commodity producers here, and the effect of the People's Bank of China on commodity producing country. And what we find here is, again, there an effect on the liquidity in the commodity producers, and an asymmetric effect on flows. You see inflows going down with a delay and outflows going up here. So again, net outflows with a different timing when the People's Bank of China tightens. All right? So that's what we can say about the causal effects of the Fed and the People's Bank of China. Now, Silvia Miranda Agrippino and Svetlana Nova have also done the exercise with the ECB, okay, using the same type of identification and looking at the causal effect of ECB monetary policy on the same style of variables. And so what they find is something interesting, which is a bit in between what I just described for the Federal Reserve and for the People's Bank of China. They do find, just like for the People's Bank of China, an effect of the ECB policy on global trade and the commodity cycle. They don't find much on financial conditions before 2008, and they tend to find more of an effect on financial conditions, but not as big as the Fed after quantitative easing policies were implementing. Okay, so after 2009, essentially, when the ECB balance sheet started to be an important policy variables, it did seem to have an impact on financial conditions worldwide. So these are the kind of 3 central banks that have been studied so far. Obviously, it would be very interesting to do the same exercise for Bank of Japan, for the Bank of England, and the RBI at some point. So it's just a matter of getting the identification strategy for which, here we use high-frequency instruments and long enough time series, but this is something that can be done. So far, this is what the impact of the main central banks look like, how they shape both the global financial cycle on the one hand and this global trade and commodity cycle on the other hand. Great. So now, what is the implication of all that? So we've seen and I'm not saying these are the only effects on the global financial cycle, and risk shocks and other such things are very relevant. Just a matter then of finding an econometrically sound way to actually identify them, because there's a lot of endogeneity in all these things. So monetary policy is so far what we have. We are on very firm ground for causality, but the rest is a little bit more difficult so far. So given that we have seen the impact of these main central banks' monetary policy on these big international financial stylized facts, now the other side of the coin is, does that have an implication for how countries run monetary policy, right? And how they should think maybe about financial stability. So that's now what I'm going to try to discuss a little bit. And here, I'm going to go into one of my favorite international finance concepts, which is the famous for people who study international finance, the trilemma. Okay? And I'm going to refresh the memory of the people who may not be so familiar with international finance about the trilemma. That's the trilemma in international finance. It says that the three angles cannot be there together. So you cannot have at the same time an independent monetary policy, free capital movements, and a fixed exchange rate. It's impossible to have these three things at the same time. And for those of you who, for example, remember arbitrage conditions such as uncovered interest rate parity, so it's kind of easy to guess why. Uncovered interest parity, it's an arbitrage condition between two interest rates across two countries when the two interest rates are expressed in the same currencies. Uncovered interest parity holds when you have free capital mobility. So if you have free capital mobility and a fixed exchange rate, uncovered interest parity tells you more or less that one interest rate in a country is following the interest rate in the other countries to which you are fixing your exchange rate. And therefore, if you are fixing the exchange rate of the US, if you are fixing vis-a-vis the US, and the US moves the interest rate, then you have to move the interest rate in the same way, otherwise you are swamped by capital flows. Okay, so that's the kind of rough intuition which tells you, okay, if you have free capital mobility and a fixed exchange rate, well, you can't have an independent monetary policy, right? So that would be an intuitive way of thinking about this triangle. So obviously, countries are positioning themselves, depending on their preferences, picking 2 out of 3 of these triangles. If we think about the US and the euro area, they have chosen free capital movement and independent monetary policies. Okay, so that's, but therefore we would not think of fixing the euro vis-a-vis the dollar. Okay, that would be clearly impossible. Now, some other countries prefer to have fixed exchange rate or very tightly moving in a narrow band and free capital movements. That would be Denmark vis-a-vis the euro, for example. Denmark is a small country, very much integrated, so with the euro area, so benefits of having a fixed exchange rate, but then it doesn't have an independent monetary policy. This is okay for Denmark. It's so integrated within the euro area that doesn't care that much about that. Now you can also choose to be more on that side. And here, we have, for example, some various India periods, depending on the strength of capital controls, that I put here after the taper tantrum, because I know there were increased restrictions on capital flows after 2013. Here you have potentially an independent monetary policy, potentially managed exchange rate, and potentially capital controls or some restrictions. Okay. So, of course, this is a convex combination, so the exchange rate may not be completely fixed, can be managed, and the capital controls may not be complete, they can be selective, so it's all possible convex combinations. Right, so the trilemma tells you for sure that fixed exchange rate mean no independent monetary policy. So independent monetary policy requires either floating rates or capital controls. And the corollary of the trilemma, or the way it has been interpreted mostly, is that under capital mobility, floating rates allow an independent monetary policy. And this is that bit of the trilemma which is challenged by the global financial cycle. So as I shown you, because we have a global financial cycle which applies both to advanced economies, to emerging economies, essentially even if you have a floating exchange rate, your financial conditions are very much influenced by the US Federal Reserve, potentially by the ECB, potentially by other central banks. Okay, so that means that you may not be in complete control of your monetary policy conditions, of your financial conditions, even under floating rates. That's due to the existence of financial integration and the global financial cycle. And so here, I'm just going to discuss a little bit of evidence coming from a new paper by Leo Gopinath and Kalem Lioskan, which discusses in more detail what happens to the pass-through of monetary policy for emerging markets. And it contrasts both emerging economies and advanced economies. So let's start with advanced economies. In advanced economies, as you can see on this panel here, you see this panel is showing you the correlation between GDP at different horizons. So on the horizontal axis, you have different quarters, so it's different horizons, and interest rates. And you have the policy rate, which is in blue, and a short-term market rate, which is in red. And you see here that on average, for advanced economies, when times are good, GDP is high, you tend to see a tightening of policies. Okay, this is what monetary policy usually does. If you have a GDP which is booming, you tend to tighten monetary policy. Okay? And you see that when you tighten monetary policy, which is the blue line, actually the short-term market rate also tightens. So the short-term market rates goes up as well. That means there is pass-through, maybe complete pass-through or not far from it, between the policy rate and the short-term market rate. That's what this graph is showing you. So the disconnect on the right is essentially zero. That means there is no disconnection between the policy rate and the short-term market rate. The pass-through is there. Now, if we take emerging economies, there is a disconnect, meaning that you might have a tightening, that's the blue line, of monetary policy, again, when times are good, but you see that the red line is not following. The pass-through is very incomplete. In fact, the red line is going down. Why? Well, because the short-term market rates also reflect some risk premium. And actually, so on average, for emerging markets, what this shows is that you might be using monetary policy in the same ways as advanced economies, but the pass-through is just not there. The kind of market rates behave totally differently because of movements, adverse movement in the risk premium. And so there is a disconnect between policy rate and market rate. So if that's the case, then, and you want to remedy that, then you have to have a better control of your monetary conditions, which partly are linked to international capital flows, partly are linked to possibly some developments in your domestic financial markets or credit conditions. And how do you manage this? Well, you can manage this either using some type of capital control or either using macroprudential policies, which are being a lot more operational these days than they were, at least for advanced economies, and which are being used a lot more extensively in a lot of different ways now in a number of markets, including in the euro area, where they are very actively used in different markets. Now, you may want to do that to actually increase the effectiveness of monetary policy and also, of course, to guarantee financial stability. Now, you may want to use those tools for the loosening to be more effective. If you want to loosen monetary policy, then you may want to, at the same time, make sure that the transmission is there or make sure that you don't have any financial stability issues. And for the tightening, you may want to avoid nonlinear effects coming from financial instability issues. So I will develop that a little bit now when I discuss a little in more detail macroprudential policies, which is the last bit of what I want to discuss today, I can reassure you. But it's a very natural complement to monetary policy, and I think it's more and more of a complement now than it was. And the reason why I think I see more macroprudential policy tool now as a complement to monetary policy independent and to ensure financial stability is that I think that what we have learned more in terms of economic research in the recent years is that an important channel of transmission of monetary policy is the so-called risk-taking channel. And this is something that was not necessarily modeled at all in a lot of our new Keynesian models of monetary policy, which are used in central banks. So what I showed you in the context of a global financial cycle is that when you have a monetary policy tightening, essentially VIX or other indices of global risk aversion go up, right? And when you have, by symmetry, when you have a monetary policy loosening, you have an increased risk-taking, okay? And it is an important channel of transmission of monetary policy. And as a matter of fact, what we have also learned the hard way, and there is a very, very important literature on this which have increased sizably in the last year since 2008, is the importance of credit booms and asset price bubbles for financial crises. So this is something that has been established now by very many papers, that historically some of the best indicators of financial crisis, especially the very severe ones, are credit growth, a combination of credit growth, excess credit growth, and asset valuations which become bubbles, essentially. So when you have the two, this is an extremely dangerous situation for financial stability. So it turns out that when you have long periods of monetary policy loosening, you have a positive effect both on credit growth and also on asset price inflation. So you see the buildup of vulnerability. And of course, once the leverage is up in the economy, relatively small shocks or a monetary tightening tend to lead to a financial crisis with probabilities which are too high to be comfortable with. Now I'm showing you just exactly what I just said, so I won't spend much time on this. This is essentially the probability of a financial crisis as a function, this is the blue line, as the 5-year change in credit over GDP. So you see as the 5-year change in credit over GDP goes up, you see the probability, it's a convex function, the probability of a financial crisis going up significantly. This is the blue line here. And if you put both credit growth going up and house price bubble, you tend to find very significant increase in probability of crisis, especially house price bubbles, seems to be particularly bad for financial stability. Okay, so this is just, there are lots of papers looking at these things. These graphs are taken from a survey of Sufi and Taylor in the Handbook of International Economics. Now, we have seen that quite a bit in the euro area, and we have seen in particular, in the context of here the early 2000s and after the 2008 Lehman Brothers crisis, we have had the euro area crisis. And what has been extremely striking in the euro area is the importance of the real estate bubbles in countries which have faced very deep crises, very deep and severe crises. So you have the first graph is Spain, where you see a massive real estate bubble here, and that's credit to GDP going to real estate. So you see that the blue line is, there was a lot of credit to real estate in Spain, but also in Portugal, also to construction in Greece, and in the case of the Japanese financial crisis, there was also a very massive allocation of credit to real estate. So these are really flashpoints in terms of financial stability issues. And we know that monetary policy, the transmission channel goes through risk-taking. It goes also through the so-called collateral channel. So you tend, when you loosen monetary policy, you tend to lend more to the real estate sector. The value of collateral goes up. So we also have a lot of economic theories on that, which have been developed over the years. Now, this type of credit boom, when it goes to the real estate sector, here more generally the non-tradable sector, tends to lead to recessions after the credit boom. So here we have real GDP response to a credit boom to the non-tradable sector on the right, and to a tradable sector credit boom on the left. So a non-tradable on the left and tradable on the right. So you see that the non-tradable credit boom sector goes to triggers some recession down the line, while the tradable sector, it's not the case at all. Okay, so this is again some recent work by Müller and Werner at MIT. So this all fits together, and there are lots of papers along those lines to to put some warning about the effect of risk-taking, monetary policy, allocation of credit growth, excessive allocation of credit growth to the collateralized sector, in particular the non-tradable and real estate sector. Okay, so this is things that are coming time and time again in banking crisis. If we look at non-performing loans, here after a number of famous banking crises, Mexico, Thailand, Indonesia, Turkey, Argentina, Italy, Latvia, Croatia, Spain, Portugal, and we look at the share of non-performing loans which are in the non-tradable sector, and this means more or less real estate, you see that this is really dominant. Okay, so that's very important. Therefore, to try to get at that by using these famous macroprudential policies, which are argued are important in taming financial conditions, so as a complement to monetary policy, and as really some guidelines to make sure that financial stability remains under control, in particular, being very careful about this real estate bubble that we just looked at. So what do, in my view, macroprudential policies look like, which are, able to deal with this type of issues? And I have to mention I'm on the French Macroprudential Authority, but I'm talking here purely under my name and not under the name of the French Macroprudential Authority at all. I think you have to make sure that there is enough capital in the banking system to absorb the losses. And liquidity coverage ratios are also an important macroprudential tools. It's very important to monitor the situation in the real estate market and to make sure that the lending standards there are good enough and that risk concentration is monitored for all the reasons we have just seen. Now in the new world we are in, we have non-banks, and some of them have an active role in real estate. So it's important also to think about their leverage and their liquidity requirements. And finally, because there are lots of risks which are relatively hard to monitor prima facie with ratios or things like that, it's important to do regular stress tests. So I think that would be my, if I have to make a short list of the important macroprudential policy in a world of globalization where we do want monetary policy potency and make sure, or try to make sure that financial stability is under control, that would be the type of macroprudential policies that I would focus on. Now I'm just going to conclude. I think what I've tried to show very briefly, and obviously there's a lot more in a bunch of papers, is that financial integration has quite a profound way in the way monetary policy and macroprudential policies operate, and in a way should be complementing each other. It's true for advanced economies, it's very true also for emerging markets. We have rediscovered that monetary conditions, risk-taking, and financial stability are very intimately linked, and the global cycles are particularly, I think, are quite potent. They are driven in part by central banks of large monetary areas, but not only. And I'll just finish by this, just to open a little bit the debate, that if I think about the structure of the international capital flows, as the way we have seen it, we've seen that these financial flows, they reflect these global factors, the global financial cycle, the global commodity and trade cycle, and they don't reflect something that we will need a lot of, that's been mentioned several times today, which is the green transition. Okay, and these big financing flows that will be needed in order to enact the green transition. So right now, capital is not channeled to places necessarily where there is a high marginal social value, climate and biodiversity loss mitigation. We've seen that when we let financial engineering run its course in this dollar-based financial system, it did not create any kind of assets that would improve this allocation. In fact, what we saw is the creation of a large amount of dollar-denominated mortgage-backed asset securities, so real estate assets and stuff like that, which was then shipped around quite a bit and contributed to the 2008 financial crisis. So if it doesn't seem that the market, in a way, gets it right in terms of this capital allocation. And so if we want to reverse that, I'm afraid that means quite a bit more monitoring of the types of investment that the multilateral investment banks are going to be doing. And in particular, the big question is how to scale up possibly blended finance to finance energy transition and to finance all the trillions of investment needed for the green transmission, in particular in emerging markets, including in India. So let me stop here.
Thank you. Thank you very much. That is extremely wide-ranging. I think I would very much want to come to your last slide, but there's a lot more there. I'm going to, as it were, take the first couple of minutes to make sure that at least I've understood part of your paper. But while there are certainly people in the room who, will have questions, I would certainly look for some comment from Bery, from Martin, from Montague, from Poonam, from Ken, so we can talk about, put the scholarly paper in a larger context. And as I see it, there are lessons for financial integration, there are lessons for domestic policy, and then there are lessons for the international architecture. And that's a lot to get through, but we have 35 minutes if we stick to time. Hélène, just so that I'm sure that I understood, in a kind of concrete way, let's take, as it were, what many of us think of as the relationship between the dollar and oil prices. Okay, so there was a kind of rule of thumb that when the dollar strengthened, oil prices weakened, etc. That was then. Now, could you unpack that correlation as you think of it now with a commodity channel, with a dollar channel? So are those old relationships still valid? Are they affected by the Fed? Are they affected by the PBOC? Could you just, use that example to, as it were, illuminate your research?
Thank you. So that's a tough question. So yeah, there are correlations. Now, to put some structural interpretation of this correlation would require a much more complete model than what I have here. The only thing I can say from what I have done empirically are the conditional correlation caused by monetary policy. So I can tell you, for example, what the Federal Reserve does to commodity prices, what it does to the dollar exchange rate, and I can also tell you from the point of view of the People's Bank of China where the effects are. Now, these two main central banks create a number of responses, both from international financial market, but also from the trade side, from commodity producers, and this has an effect on the demand side, which then will trigger also possibly effect from the supply side. Okay, so this I cannot identify. I mean, in my framework, the only thing I can identify in a causal way are the effect of the Fed and the People's Bank of China, and my co-authors could from the ECB as well, both on commodity markets and on the dollar exchange rate. The rest, you have to go to a more complete model where you would feature both the supply and the demand side of things in order to then reproduce the observed correlation of the dollar and the oil price. So I cannot unpack everything for you, I'm afraid. The only thing I can say is that you do find that, when the People's Bank of China has a monetary expansion, this has a sizable effect on commodity markets. So this seems to go through and this seems also to cause a lot more trade. So this seems to go through a demand side, which is sizable. But there's also some of that from the Fed. This is not the only effect, though, that is going through the economy. So that's only a conditional one. So I'm sorry I cannot be more specific, but because you do need a bit more than.
For a country like India, for whom the oil price is very important, what you're saying is that it's become a lot more complicated now. You've got to be thinking about multiple monetary policies,
yes.
Working through an exchange rate channel, but also working through a demand
Through a
channel,
demand
and
channel, yeah.
possibly a supply channel as
And
well.
possibly then the supply will react in different ways, depending on
Yeah.
the geopolitical circumstances, depending, what right now what's happening in the Ukraine war. So that's indeed a whole set of issues, which some of them are outside economics.
May I just also ask you to illuminate what you meant by the risk-taking channel of monetary policy, because I wasn't very clear on that.
Yes. So what is interesting is that in economics, for quite a while, a lot of the models used by central banks in order to think about inflation, so are around neo-Keynesian models with Phillips curve, okay, and we know that these models have been a bit challenged recently, and interestingly, very few of these models, first of all, had a financial intermediary sector. Now it has been added a little bit. But also very few of these models were modeling time variation in risk premia, okay, or were taking seriously the fact that monetary policy could actually have a causal effect on risk premia. Now, the risk-taking of channel of monetary policy is to say, yes, in fact, monetary policy does have an effect on risk premia via the risk-taking behavior of different players, which can be financial intermediaries, which I believe is very important, which could be households, but I believe more in the importance of financial intermediaries. And you do find in the data that when, for example, the Federal Reserve loosens monetary policy, the VIX goes down, okay? But you also find that the leverage of not only US intermediaries, but also the global banks in Europe goes up. So that's what I mean by the risk-taking channel of monetary policy, this causal effect of monetary policy on what financial intermediaries do, not only in the US, but also elsewhere. And of course, this then has further effects both on economic activity and also on financial stability. Okay, so there's all kinds of amplification mechanisms then which can kick in.
Okay, so as I say, I see issues connected with domestic policy in advanced countries, domestic policy in emerging markets, and then cross-border and international architecture issues. Martin, you were a member of the Vickers Commission. You've commented to some extent on some of the dysfunction of the financial sector seen from a domestic perspective, and I think you were partly responsible for the whole idea of ring fencing of domestic subsidiaries of banks. So what did you take away from what Hélène had to say? And then we can come to the implications, as it were, for the global economy.
Well, first of all, it's a wonderful lecture and has set out given a wonderful summary of the literature in this area, and I think people here must have found it very, very illuminating. I certainly did. And of course, Hélène has been one of the 4 or 5 leading figures in this. And the second conclusion is, if you think the global financial system is a worrying mess, you don't begin to understand the extent to which that is the case. That is, I think, the lesson I've drawn from this, because the simpler views we used to have about, those of us who learned decades ago from the feet of people like Mundell, it was a simpler world intellectually, and a lot of these problems, particularly, for instance, the risk channel, were not things we weren't aware of. In the answer to your specific question, we made the assumption at that point that we were going to continue to be an advanced economy. That looks a much more debatable proposition today than it did then, but a lot happens in 13 years. And so far, and it's crucial because it gets to my first question for Hélène, that is to say, we thought we could run our economy in our own currency, and the changes in monetary policy environment would not fundamentally alter, but there are important exceptions, the risk characteristics of the financial system. But there was, from our point of view, one overwhelmingly powerful exception to that, which had emerged in the crisis, which is the linkage, if you like, of financing markets, international financing markets for the banking sector. So the core of the crisis for the UK, the global financial crisis, was that a large number of bank and quasi-banking institutions financed themselves not with deposits but in the repo market. And the repo market, even though they were financing themselves actually in sterling predominantly, for domestic transactions, for mortgages for instance, were so highly correlated across the world that when we simply didn't realize the sort of runs that would emerge. And the whole purpose of risk-taking is to ensure that the domestic retail banking sector would be free of that by basically being forced to fully subsidiarize the entire balance sheet for the retail bank. It is a very interesting and complicated question, which I don't want to go into here, because is whether that will still work. Because I can certainly imagine circumstances in which it won't. And the crucial circumstance is if the retail banking sector, as we know it, is replaced by in significant measure by a non-bank financial sector, not regulated like the banking sector, which becomes more or less internationally integrated. In other words, we recreate the international exposures that we've tried to eliminate through shadow banking. And if you read, I wrote about this week, the Basel Commission, the Bank for International Settlements report on the financial sector and the current, what's going on right now, that's quite obviously actually their single biggest worry. It's not what's going on in the banking sector. It's not Silicon Valley Bank or the Credit Suisse fund. It's the shadow banking. And so I would stress the importance of that question. Now let me just, so my basic view is you regulate to solve these problems, and of course the geniuses in this sector will find a way around it. And that then gets to a question and then a kind of comment on the question I have in thinking of, you're sort of giving a story which basically correlates rather nicely with what the Latin Americans used to call original sin. Namely, if you're an emerging or developing country, you have a real problem in getting the financiers of the world to treat you as if you were a serious country. And for that reason, in a book I wrote on this, I argued that no sensible country, if it could possibly avoid it, would ever borrow in any currency other than its own. And if it is going to borrow in a currency other than its own, it can expect real problems, because if the conditions in that country force a change in monetary policy, which leads to a large change in the exchange rate of that currency against yours, and your balance sheets on the liability side are heavily denominated in the currency of the country which has just tightened its monetary policy, you are completely screwed. And I remain, and I think the story that Hélène is saying must be very consistent with that sort of story. And it's a huge challenge for emerging and developing countries. So that then leads to the sort of two big questions. So what should emerging and developing countries do? In deciding what they should do, apart from creating a situation in which their currency becomes the dollar, why not? 100 years from now, the rupee may replace the dollar. Maybe it's 50. Anyway, that's one strategy, but it's going to take quite a while. In the meantime, what the story that Hélène is telling is that the risks of being completely integrated in the global financial system are very high. And my view is that the benefits are close to zero, so why the hell would you do it? But that's not on equity, so portfolio flows are possibly, once you get involved in the global, the banking system, the rest of it, you are in real trouble. And then the second point that I think is crucial brings us back, since you talked about to what sort of Keynes would say about all this. And what he would say about this is, if you're concerned about developing countries, you need effective insurance mechanisms. And since we don't have them, and we're not going to create them, that underlines the immense risks of integration on the financial sector side. And I think all the work she's done, I'm sorry this is long, that Hélène and others have done, underlines the risks that have to be managed if you're going to be fully integrated into the global financial system, and you're not the US.
Okay, but so Hélène, I mean, there's a lot there.
Yes.
Whether there was a question is for you to decide. But you know, this is an important intervention by a thoughtful person.
Yeah,
How do you want to react before I move on?
Yeah, no, so absolutely, there's a lot that was said here. And I agree with quite a bit of it. So in particular, you know, so the integration via the non-bank is clearly an issue that everybody is keeping an eye on, but doesn't mean that anything can be done in the short run, because we just don't have, for example, the macroprudential tools that can be useful to deal with these type of issues. I mean, we can think about a few things like, you know, restrictions on leverage. We can think of putting some liquidity requirements, which I think would be very, very useful. So we can try to think about this type of mitigation instruments that at least mean that this kind of integration, if something goes wrong, would not, you know, there would be a bit of absorption of a risk rather than a total propagation. I think we have to think about those types of instruments quickly, and probably that's what the FSB is on to that. But I also think that for emerging markets, so indeed, and there's Bery who will be able to expand a lot on the original sin and all these issues there. So looking forward to see what he has to say. I think we have made some progress in terms of decreasing the liability in dollars. At least that's what, you know, the official data say, that emerging markets have, for the ones which were larger economies, adopted a monetary framework which is much more conducive to stability, namely an inflation targeting framework. So I'm not saying that floating exchange rates are not a useful tool. They are to absorb large shocks. And indeed, when you are a large economy and you want an independent monetary policy, that's a prerequisite. So a lot of emerging markets have actually adopted this monetary framework, and that's a way forward. They also have adopted a lot of macroprudential policies. Actually, emerging markets were ahead, and India was ahead in macroprudential policy to a large extent before the euro area even had macroprudential authorities. And I think this complementarity, with a bit more flexibility and this macroprudential framework, less dollarization of the liabilities, is showing that, is making progress. Now, there's also a lot of issue with the official data of international debt flows, and we know that a lot going through offshore centers. If we were to look at the data a bit more closely, there would be more dollar debt than what we think, because a lot of the debt which is issued in the Cayman Islands or in other offshore centers are actually dollar debt, and they are not counted in the official balance of payment statistics. So I would still be worried about those issues, but I think we have maybe a little bit more of a control on those issues than we used to. So that would be my a little bit optimistic assessment on that one, but I'm curious to see what Bery has to say.
I'll come to Bery in a minute, but Montek, if I could just turn to you on a couple of points. Obviously you're knowledgeable about the global financial system, and really Hélène's message, certainly for in India, is that the two are interconnected. But what alarm bells went off in your mind when she talked about, as it were, the downside to credit booms in the non-tradable sector, and also what, when she says that, to some extent India was ahead in terms of macroprudential. So what do you think are rules of the road that apply to an economy in our situation? A question I would have for Hélène connected with that is, so it's a source of some worry in India that our financial depth is as little as it is. So in thinking about all of this, how important is financial depth? I suppose, amongst other things, it allows you to finance yourself in the local currencies. So that's one thing. But let me come to you, Montek. So both in terms of domestic policy, but then also what this means for integration.
Thanks, Suman. Well, first of all, let me join Martin in thanking Hélène for what I thought, for me, was very, very illuminating lecture. And I generally agree with the sum total of what she said and Martin said, because he really elaborated these issues quite a bit. I think you touched on one or two interesting things on which I just want to make a brief comment. One, you're absolutely right that virtually all comparative analyses tell us that the credit to GDP ratio in India is very low compared to other emerging market countries. Now, that would suggest that a bit of a growth in the credit to GDP ratio would not be a bad idea. And the question is, when is the Reserve Bank going to start getting worried about that? Because it signals the credit boom and all kind of consequential macroprudential problems. When is it just getting back to normal? Now, related to that is, I think what Hélène brought out very nicely was, credit to construction and real estate. Now, real estate, of course, in the US led all this in the great financial crisis. But on construction, it's also said in India that our infrastructure is way below what it should be. So if we're going to have an increase of investment in infrastructure, it's going to have to be financed by an expansion of credit. So therefore, an expansion of credit into construction, which is after all the other side of infrastructure, may well be part of somewhat India getting to normal rather than a sign of India getting in really bad shape. So I don't know how the guys who look at these things in the Reserve Bank, how they look at these two factors. So any comments that anyone, Hélène and others would have, I would find very useful. One particular question that I had came right at the end of Hélène's lecture when she said something about blended finance. This is in the context of the investments needed for climate change. This has become, at least in India, a sort of buzzword which simply evokes generally positive reactions. I've frequently been in meetings where everybody says, how on earth are we going to finance all the climate finance, the climate management investments? We don't have the resources. There's certainly no chance whatsoever. I don't know if the Paris summit gives you a different perception on this, but my perception was that any expectation of massive increases of financing from the multilateral institutions would be somewhat premature. Now, in the light of that, people say, oh, blended finance. Now, I think there's a problem here because nobody quite defines what they mean by blended finance. If you look at what many people are saying, the usual argument is that, look, the economics of putting up, let's say, solar plants or wind power plants in India are overwhelming. They won't happen because they're very capital intensive, and you cannot borrow in India except at very high interest rates. And this would be true even if you were borrowing from abroad. Either you would be borrowing in dollars, even then there'd be very, very high risk perceptions. So everybody says, well, blended finance, as if there is some financial engineering that will get around what is currently a problem of very high perceived risk in the climate finance area. Now, this touches on something that came up this morning. There is risk which is to do with technology. I think that's well understood. So it's no greater in India than it is anywhere else. There is risk in terms of whether your projects might run into regulatory constraints, environment clearances, this, that, and the other. Those can probably be handled. But risks related to a collapse in the exchange rate, that is not so easily handled. But then I find a lot of people saying that that's what the IMF should do, provide risk guarantees, or for that matter, even the World Bank. Now, this raises a question that if you're going to provide a risk guarantee, that guarantee must be priced. And are the multilateral institutions going to get into this kind of blended finance in an innovative way? And if so, are they going to price the risk distinctly for each country? in which case they're going to have to be able to say that in the case of country A, the premium is going to be so much if you want a guarantee. In the case of country B, it'll be much less. Or are we going to do what the World Bank does now, or for that matter the IMF, which is there's a uniform price. Now the logic of a uniform price is there's differential conditionality. But that cannot be you brought in when you talk about blended finance, you're lending to a private sector organization. So the long version of my question is to sort of persuade Hélène to answer the implications of her statement that there is a role for blended finance in terms of the questions that I'm now raising. How does she see these things being addressed? And is this going to be a solution that the multilateral development banks and or the IMF will somehow provide internally? And is it going to be consistent with the way they normally operate?
Hélène, do I have your, do I have your indulgence to get a few more questions, then give you time at the end? Or
sure.
Would you? Yeah, okay,
It was
fine.
a very substantive question, but
Yeah,
I'll
okay.
remember it.
Right. Ratna, I'll come to you in a minute, but Bery, I will turn to you perhaps only because, a book that you wrote, I think in 2006 has kind of stayed with me, which was Global Imbalances and the Bretton Woods System, which drew this distinction between, as it were, the core and the periphery at the time of Bretton Woods, when Europe was the periphery, and, as it were, the core and the periphery, which to some extent is now picked up by what Hélène had to say, talking about the Euro system and the Fed now as being the core, and countries like India, China being on the periphery. To some extent drawing on what Montague had to say, so yes, there are numbers coming out of Brookings and Nick Stern and Vera Songway, etc., about expanding the flow of finance for climate change, for infrastructure, what have you. But all of that actually will require an increase in sustained current account deficits for a while. And I'm not sure that we have a global monetary architecture that actually is consistent with that. Certainly not the picture that Hélène has painted, risk on, risk off, etc. So it's not actually a part of our current G20 architecture, but can you articulate over and above what your joint paper with Poonam has said about what the ask should be by the emerging markets in monetary reform?
I don't really have an answer to that question, but I think the implications of Hélène's keynote is that relying on large foreign financial inflows to finance the climate transition is risky business, and that it may have to be heavily financed, even in poor countries at home, for unless there is that massive increase in concessional finance that was discussed but not advanced in Paris. I want to make a couple of other remarks. One is to observe that right before Hélène's keynote, I did a segment on CNBC India, and the main thing they asked me about for 20 minutes was, what is the Fed going to do, and what are the implications for India? So financial commentators here know about the global financial cycle. They believe in it, and they worry about it. On Martin's comment and original sin, so I've been called many things over the years, but never a Latin American. The implications of this observation that many emerging markets and developing countries historically have only been able to borrow abroad in somebody else's currency
are very similar to the implications of Helene's framework, trying to exercise an independent monetary policy which causes the exchange rate to move can be disastrous if your external liabilities are denominated in somebody else's currency. So in some people's minds, what flowed from that observation was you could regain your monetary autonomy if you developed the capacity to borrow externally in your own currency. So here we're not talking about India, right, which doesn't really fund itself significantly externally through portfolio capital flows. But those who coined this unfortunate term, original sin, never argued that if you acquired the capacity to borrow abroad in your own currency, all problems would be solved. And that's what we've discovered recently, that all problems are not solved. So Augustin Carstens and Yun Shin have this work on original sin redux, which goes to the point, even if your external debt is denominated in your own currency, for foreign investors, it's denominated in somebody else's currency, and there's still a balance sheet problem. It's just on somebody else's balance sheet, and you haven't regained your autonomy from the risks that arise when you try to exercise an independent monetary policy and the exchange rate moves. On the global architecture, what I took from those two colorful diagrams at the beginning was that there is an imbalance between the structure of the global economy, the trading system on the one hand, and the monetary and financial system on the other hand. So the trading system is growing more multipolar and the monetary system is still heavily dollar dominated. A couple of questions about that would be, do you think this is a problem? That was Suman's question, essentially. And another question would be, in those diagrams, where does the seeming importance of the euro come from? So all the other statistics I look at on foreign exchange market turnover and the currency composition of foreign exchange reserves and so forth, all the other statistics in the European Central Bank's hopeful annual on the international role of the euro don't put the euro on a parity with the dollar, but in your measure of financial interconnectedness, you do put them on more or less on a parity. So I found that unusual and surprising. And finally, I thought your new results for the PBOC were very intuitive, that everybody thinks that what goes on in China has a first order impact on global commodity markets. So it follows that what the PBOC does could be consequential there. So it's reassuring you find that in your data.
Thanks, Bery. And Hélène, you will be given and deserve 10 minutes for response, but let me therefore ask Ratna to be the last commentator in formal session, but we are meeting over cocktails and dinner after this. But Ratna, while you're no longer at the fund, and you may have had a totally different question, but I'm from this distance, one hears sort of mantras like integrated framework and things like that. So can you illuminate what rules of the road, fund, as it were, guidance is trying to move towards in what seems to be a very messy global environment, and anything else you might have to say?
Thank you, Suman. That's exactly what I was going to talk about, which is, let me just tell Montec, IMF is not in the near term going to be a credit rating agency. It's not happening. Dollar is going to be king for a long time. This is to Martin's question. So in the meantime, we have to get practical. And we actually do, I'm saying we in the sense of the IMF because I've only just retired. Because I was closely involved in developing this framework, which is the integrated policy framework that you mentioned. And this framework is really a very practical solution. So what it basically says, in very simple terms, is that there are spillovers from US monetary policy. There's work I've done with Cicchetti, which shows there are no spillovers from the euro area. It's only from the US. And what the policy says is that in responding to the US monetary policy spillovers or capital flows, emerging markets monetary policy, domestic monetary policy is not sufficient. So you may need to combine it with 3 other tools. One is macroprudential policies that you mentioned, Hélène. The second is capital controls. And the third is buildup of reserves, actually. And again, some work that I've done, it's going to come out soon, actually shows that preemptive measures of macropru or capital controls are much more effective. In fact, if you impose these policies during the crisis or after, it's not effective. So there's a very strong case, actually, for combining it with these 3 other policies. And I was a little surprised that you did not mention capital controls, at least not in your final slide.
I did mention it.
Yeah, you mentioned it.
I might have called them capital flow management, I don't know.
Yes, the CFMs, that's what the IMF calls it. And I just want to also say that this integrated policy has been adopted and approved by 190 member countries. So it's now legit to combine it to tackle these problems. Thank you.
Okay, so Hélène, I'm going to take the indulgence of the organizers to give you 10 minutes to react to the various points that have been made about blended finance, about, as it were, the role of the euro in your presentation. But can I just also ask you to add to that? So where does this leave members of the EU who've not chosen to join the euro? I mean, what kind of world do they inhabit? Over to you.
Thank you very much, Suman. So yeah, there were a lot of fascinating points. So I hope I will kind of, give justice to all the ones I can within these 10 minutes. So on the first issues between actually you and Montek was about this credit deepening issue of India. So indeed, I mean, it is a little bit of there's a two sides to this issue. So on the one hand, credit to GDP is an indicator of financial development, right? And so you do want, in principle, to have developed financial markets to finance investment at home. So in the case of India, indeed, markets look a little bit shallow, and so further deepening seems to be on the cards, with all the caveats that whenever you liberalize and if you open up, we know we have a lot of historical experience on, the sequencing and how to do it in order to avoid precisely the type of excesses, so overaccumulation of credit or excessive growth, that are the dangerous bits that may lead to financial crisis. So I think you can have financial deepening. What needs to be avoided is this type of credit boom and bust. And so the credit booms are usually associated with, over-exuberant financial sentiment, with asset valuations which are very high, and possibly with concentration of risk. When the concentration of risk is especially in a sector when the supply is relatively inelastic, the supply of capital is relatively inelastic, such as can be the housing market. That means that the valuations can go up, they feed the asset price bubble, the leverage increase, and this is where you have a very unfavorable dynamics. But if the credit deepening leads to an increase in supply capacity, could be of housing if it's not oversupply, it could be, of course, of infrastructure if it's again needed. So we all have in mind also what happened in China when there was overinvestment in housing in some third-tier cities and a lot of unoccupied, etc. So you have to watch out for that, I guess. But some deepening and some increase of construction, if it is in the spirit of increasing the capacity of production of the economy, of providing more housing, which is needed, is totally okay. I mean, the problem is this destabilizing dynamic, which is very much linked usually to overvaluations and bubbles and excessive leverage. And that's where the excessive leverage, it can come from the banking sector, it can come from the non-banks. some of them being very active in this type of, so that's where, and in India you did have some issues from that point of view in the past years. So that's, I think that's where the macroprudential authorities and of course the micro supervisor as well are very, very needed to monitor the situation and the lending standards, etc. And it's a very political decision to talk about lending standards and to monitor them, and it's not easy to do. But I think it's very important to look at that, and you need data for that, and you need also a legislative framework that allows you to do that. And it's not every country which has it. So, but that's a very, I think, high return investment to do in policy to focus on those issues. So that was for the first, for the credit deepening issue. Then we had the blended finance issues. So indeed, yes, financial engineering. So, and the point was precisely that financial engineering in the past, what did it create? Asset-backed mortgage securities, right? And again, this sector collateralized, very sensitive to, increasing liquidity, everybody pouring money into it, and then we know the securitization, and we know the global financial crisis, and all that. So the point is to try to do financial engineering that can contribute to the green transition. And indeed, I think when you look at the numbers, the estimated numbers, which vary a lot, but of the investment that is needed for the green transition, but for many countries, but that definitely includes India. When we talked about the fiscal capacity this morning, and it was, probably there will be some additional capital needed. So the question is, is it possible to do financial engineering that would help? And so there has been some pilots in terms of small blended finance things. So I think the key, and I don't know if these pilots can be scaled up, but if they can, maybe that's one possible lead. So the idea is the following. You have the asset owners in rich countries. You have some asset managers. These investors are risk averse. And there's also huge information asymmetry in terms of investment in emerging markets who would need finance. So you need to bundle them somehow with people who can overcome the information asymmetry, who have the knowledge of the local economy, and who do the green investment that are needed. So you need some kind of certification that is not greenwashing. So you need authorities who are able to certify the type of investment that would be useful. You need the local financing by people who know the economy. So you need the local financial system or private, local banks or something like that. And then you need, to join the asset managers to this local system. And you need to overcome the risk aversion of the asset owners. And that has been done by using the balance sheet, the de-risking, the balance sheet of some multilateral institution. So could be, can think of the usual Washington suspect, right? Not the IMF, but we can think about the World Bank. We can think about other regional development bank. So that's the idea of leveraging the balance sheet of institutions. So there has been some small scale investment like that, which seems to be working. The question is whether it's scalable or not. And I don't know, and I think that's something that, I think it's in the spirit of what was tried to be done in Paris. I'm not sure there has been a lot of progress being done last week, but I don't have any specific report on that. But that would be the idea of blended finance. So it's really putting together all these things and hoping that there is some scalability in this. So that relies on, on a number of assumptions. That's granted.
Loans, separated them into high quality and low quality. And the current argument is that the world's pension funds will buy the high quality loans and the World Bank will buy the rest. I mean, I wonder how that's going to work in practice, that's all.
Yeah, no, that's more about absorbing some kind of absorption of a first loss or something like that. Yes, and yeah, lots of question marks, but I think we have to think about this if we want to make any progress. So financial engineering could do some things, and we can learn from the current experiences, which seem to work, some of them. So that's this. Then of course we had so Bery. So it's measured by portfolio flows. So it turns out that gross portfolio flows are quite important from the euro area or Europe in general. From an international point of view, because we know that the gross capital flows, they come from big advanced economies to other big advanced economies. So granted, that gives a little bit more of a weight than you would usually see to EMU. So if we would take the other traditional international currency measures, indeed, Europe looks smaller. But this particular measure on gross inflows and gross outflows, it's kind of relatively big. Absolutely. So there was also the issue about, okay, the disconnect between the international trade system and the international financial system. So yes, so I mean, as you know, we have had some such disconnect a little bit before between the sterling and the dollar. In the end, the dollar caught up when the US became was the biggest trader and the biggest economy in the world. It took a little while, but then the dollar established itself as the international currency with some back and forth. So we can imagine that there's going to be similar effect like that, except that it looks really like more multipolar, this world. And for the moment, it is true that we don't have the financial development in China that would justify the international use of the RMB. So it seems like we are, with the dollar for a while, as Ratney said, because there's no alternative, there's no credible alternative. And the euro area could be an alternative in principle because of the size, so it could share a little bit. However, what we lack in the euro area so far is a really safe asset. I mean, we have a problem that in bad times, we have capital flight from the periphery to the core, to the bunds. And so that means we don't have really an integrated bond market, and therefore we're not very resilient. And therefore, being a reserve currency when you're not super resilient in bad times doesn't sound like something that works. So that's why, for the moment, essentially, we do have the dollar, and it's kind of stable, even though we have this disconnect. And otherwise, I'll be very happy to see your work. It sounds extremely related, etc. And yes, the international policy framework is kind of reflecting very much this type of ideas. So that's great. Thank you.
At any point?
Oh, sorry.
No, just it's a small question, but where does this leave the holdout on the euro within your?
Sorry. Yes. So the holdout on the euro, like Denmark and.
Okay.
And
that is your Denmark outcome.
Yeah. I think or Switzerland. Well, what these countries they are extremely integrated economically with the euro area, so they tend to. In the case of Denmark, they definitely manage their exchange rate. At the same time, they don't have free capital flow. So they have free capital flow. So that means essentially they are very much integrated within the ECB monetary policy. And for Denmark, that's not a big deal because essentially it's the same type of business cycle than the other countries in Europe. Now, for Central and Eastern European economies, that's maybe a little bit more difficult, but they tend to be quite financially integrated, so they tend to, to value to have their exchange rate not being too divergent, and being relatively tight to the euro because of the important international trade connections. So that's where they are. It doesn't mean that they can go in the euro area anytime soon, because it depends on a number of criteria that some of them may not satisfy. So, but they are very much in kind of standby, I would say.
Well, I think I totally concur with all the other interlocutors that this was a tour d'horizon and a tour de force. I mean, a very large set of insights, methodologies, with some slightly uncomfortable implications, which I think Martin, with his journalist flair, put very starkly. But I have to say, Bery also added a dose of cold water about, the riskiness of trying to finance the green transition through borrowing abroad. So. I mean, we will have to ponder this. Hélène has indicated some useful pilots. I had Junaid Ahmed of Menger, talking about the insurance function. I don't know that he had an answer to Montek's question. But Hélène, thank you for gracing this occasion, for visiting India. I'm aware of, as it were, the very, very complicated travel program you had, and that you made time for this. I, as somebody with roots in both NCAER and the IPF, thank you, and also very pleased to have chaired your session. Please join me in
Thank you very
round
much
of
to you.
applause.
It was really a pleasure.